Hey, how's it going, everyone? Today, let's go ahead and talk about Google. Their parent conglomerate company name is Alphabet, but it doesn't quite roll off the nipple as nice as Google. So I'm going to refer to it as Google. And here's my unpopular opinion. I think Wall Street and everyone else is wrong about Google because I truly believe that Google is undervalued right now. And to see whether or not I am wrong, in this video, I am going to look at the intangibles, the finances, and run some valuation models to figure out if it's a delicious or a disgusting dividend stock. So right now, I'm looking at their adjusted stock price total return, basically the performance. 1 year out, they're up by 15%, and it's currently trading for about $159. Depending on when you watch this, it might be like $155 or even like $162. And when we zoom out and we look at 5 years out, Google is up by 159%. When we do 10 years, it's about 400%. When we do 20 years, 5,300%. And by the way, Google offers two types of shares, right? They have Google, like what you see on your screen right now, which is the Class A. And then they also offer GOOG, which is the Class C. And this is not a video where I explain the difference between Class A versus Class C, but for all case and purposes, Class A is better than Class C, okay? In simplicity's sakes. All right, so based on the total return, we see that Google is worth investigating. So far, so good. The first metric that I am going to be analyzing is going to be the revenue. This is what investors refer to as the top line. So let's see. Back in 2010, they posted $24.9 billion, right? And as you fast forward throughout the years, besides like 2012 right here and a little bit during the pandemic, they've been steadily, predictably, and reliably have been going up in the right trend. Right before the pandemic started back in December of 2019, they posted $161 billion of revenue. What you see on the top of your screen right there, that graph, is the trailing 12 months of revenue, or how much they made in the past 12 months. And in the middle of your screen, that bar graph is how much they made in the 3 months prior to that date, which is like September all the way to December. And that was a growth of 17% from the year prior. And as we fast forward, just look at this. They're at $250 billion at the end of 2021. And are we going to hit $300 billion? Yes, sir. Now we're at $307 billion at the end of last year. And as of recently, this past summer, they posted $328 billion of revenue in the past 12 months. And as we scroll down right here, this is the revenue broken down into Google's fiscal calendar year. So in 2023, Alphabet, aka Google, posted $307 billion. And one thing that I want to point out is when we scroll all the way down here and look at 2009, posting $23 billion and fast forwarding to just last year of $307 billion, folks, this is an amazing company. Their revenue is a testimony of that. Next, we are looking at the net income. This is what investors refer to as the bottom line. And it's the exact same story as the revenue. It's going up steadily and reliably and in a consistent pattern, an upward trend. Prior to the pandemic, their bottom line, aka the net profit, was $34 billion. And as we fast forward, as of this year, the trailing 12 months, their net income is $87 billion. This is nothing short of fantastic. And as we scroll down right here and look at how Google breaks it down by their fiscal calendar year instead of the trailing 12 months, to see the pattern, the net profits go from $6.5 billion back in 2009, the Great Recession, and now it's $73 billion. This is amazing. $73 billion of net profit? My goodness, this is just ridiculous. And the next metric is going to be the free cash flow. Let me show you how amazing Google really is. Back in 2009, their free cash flow was $8.5 billion. And as we fast forward, Google's free cash flow just can't be stopped. As of last year, they posted just shy $70 billion of free cash flow. This is disgusting. This is just beautiful. So overall, in a bird's eye view, their finances are phenomenal. The next metric that I'm going to be looking at is the shares outstanding. Essentially, I'm asking myself, is Google issuing more shares and diluting the shareholders, or are they buying back shares? what we want to see is less shares outstanding, meaning each share that you own has quality over quantity. And it does seem to be the case. Up until what would you say, 2014, Google was issuing shares very aggressively. But then it kind of flattened out. And then as of the beginning of the pandemic, they just started buying back shares consistently. And now there's about 13.3 billion shares outstanding. When we zoom back right here, back in 2013, roughly the same amount of shares. So unlike the other metrics, with the shares outstanding, you want to see an inverse relationship. You want to see this number going down as we progress through the years. And it does seem to be the case with Google, which is what I want to see. This is good. And next, we're going to be talking about Google's business model and economic moat if they have one. Like, what is their competitive advantage and how do they make money? So Google is in the business of making free cash flow. And when I say that, I mean it. I'm not exaggerating. They are a tech giant in all different realms. What you see on your screen right now are all the different products and services that they offer for the consumer, ranging from Android all the way to Google Chrome, all the way to Gmail, Google Play, Google Slides, Google Voice, Waze, which is a GPS app. They have YouTube, Google Flights, translation, you name it, Google has it. And if we scroll down right here, we can see all of the different products and services for businesses. And if you are paying attention to your screen right now, you might recognize some of these. And all the way at the bottom, they also have stuff for developers, people that are into coding. Off of face value, now you can see how big of a company Google really is. And you might be wondering, well, why is this stock not doing too hot? Well, currently the company's sentiment is fearful, with a lot of headwinds over the idea that Google is a monopoly that is pending a breakup down the road, meaning in the next 3 to 5 years based on regulation and their lawyers losing the cases, meaning the different segments of their business will eventually become separate companies. That's what the bears think will happen to Google. Google is currently facing litigation and investigations from different committees all across the world for antitrust practices and behaviors. So there's a lot of hesitation on Wall Street with Google. For me, when I hear that a lot of people are concerned about Google's monopolistic practices, that just tells me that this company up front right now, bottom line up front, they have an economic moat. They have a competitive advantage. The investing thesis writes itself. If a company is doing that well, that people want to break it up, for me, I become bullish. I don't know about you. When we look at the other Magnificent Seven companies, so when we think about Apple, Microsoft, Amazon, Nvidia, Meta, and Tesla, they all have pretty high valuations, right? Their trading multiple is at a premium. But when we think about Google, their PE ratio is trailing their peers. And even though most of them are also facing pressure from the UK or Europe in general, Google is in the spotlight. And so consequently, Wall Street does not like Google too much right now. And for me, when I see a dip on a premium company, a high quality dividend compounder with cheese, for me, that's a buying opportunity. But it makes a lot of sense. Just think about it, right? Nobody ever says, yo, let's go ahead in Microsoft Bing to search for something. Nobody ever says, hey, let's go ahead and search for that topic on Vimeo, on that video sharing platform. Google's product is superior. What you see on your screen right now, this is best in class. And even their Google Play Store, what you see on your screen right now, it's either that or you have to go ahead and buy an iPhone to access the Apple version of an app store. Google literally has a monopoly in regards to Android related apps. If you want to get an app, you got to get it through Google. That's the avenue you got to go. Then again, the people that are furious and angry over Google's competitive advantages, they only need to look at Google Cloud. Because in comparison to Microsoft and Amazon's cloud, Google Cloud is a little wart on your back. So when people jump up and down and scream that Google is just a monopoly in all regards, that's just not true. Not every business segment of Google is a monopoly. Because when we talk about the cloud space, Amazon is leading the race with about 31% of the market. And then Microsoft's Azure is second place at 25% of the cloud market. As of right now, as I'm filming this video, Google Cloud is somewhere around 10 to 11% of the cloud market, which is not big at all, but it shows me as an investor that it has a lot of potential for growth. If they only have 10 to 11% of the market share in cloud, there's so much opportunity for that to become 15 or even 20% down the road. Now, here's why I really like Alphabet, aka Google. Google has a steady and predictable revenue stream from its Google search and advertisements line of business. We'll look at the breakdown later, but it makes up a majority of their income. Everything else that Google is pursuing, everything else that you see on your screen right here, is literally just them throwing darts at a board and seeing if it strikes it big. Some other areas that Google is pursuing include Google Pixel phones. Yes, they actually have a cell phone. Chronicle, which is the cybersecurity arm of Google. They have Dandelion, which is the HVAC arm of the business. Yes, you heard that correctly. Google actually manufactures AC and heating units that utilizes geothermal energy. I know, when I looked into that, I was laughing. I was like, what? They also have something called Intrinsic, which are industrial robotics for warehouses and manufacturing. There's Google Fiber Internet, which gives you speeds of up to like 1 gig. Unfortunately, it's only limited to certain cities, but the price is better than what Verizon can offer you. They also have Verily Healthcare, DeepMind AI Research, Calico Aging Research, X Development, which is their R&D lab dedicated to pumping out high-risk, high-reward projects, which I should show you on your screen right now. What you see on your screen, this is X Development. And let's just go ahead and take a look at the portfolio here, right? There's Chorus, which is developing new sensor technology, machine learning, sounds like Palantir. There's Bellwether, developing the first predictive engine for the Earth and everything on it. Okay, cool. To forecast natural disasters. Tapestry, Moonshot for the electric grid. Okay, carbon-free electricity system. So that looks like a utility play. By the way, this is all different projects that Google is pursuing alongside with their bread and butter of the Google search and ads line of business, because it makes so much money, they can afford to do this, right? There's Tara, which is wireless optical communications. What is this? 280 Earth, direct air carbon capture. 280 Earth's Moonshot is to remove large amounts of carbon dioxide from the atmosphere. That's an interesting one. There's Intrinsic, what we talked about earlier, the industrial robotics. There's Tidal, underwater sensing and perception. There's Mineral, everyday. So the list goes on and on, as you can see, right? They're also developing this one right here, like the drone delivery service, Wing. Phenomenal. So as you can see, like Google is always pushing themselves past the comfort zone and innovating. They're not like Intel. Google is not satisfied with what they have, and they're continuously pushing the boundary to see how big and how successful they can actually become through pursuing these random ass projects. So I like it. But I will say this, unlike their advertising business, most of these, what you see on your screen right now, do not turn a profit. However, like I mentioned earlier, they can afford to build it out because it's a gamble Google is willing to take since they have so much cash on hand. Remember earlier we took a look at their net profit and their free cash flow? They have billions of dollars on hand. This is a company that can literally solve problems because they have enough money to do so. What Google is doing kind of reminds me of like Facebook and the metaverse. For the longest time, when I was investing into Meta like a couple years ago, everyone was scared, right? They're like, dude, Mark Zuckerberg has lost his mind. He keeps talking about this metaverse, but we don't even know if it's going to be profitable or not. And as a result, that stock went through a tremendous sell-off, and that's when I started to gobble it up, and I just bought into it. I got greedy, but it paid off. Now, from my understanding, Mark Zuckerberg is still passionate about the metaverse, but it seems like it's not that many people that share that vision with him. But hey, this video is not about Meta. If you want me to make a video about Meta, just let me know and I can go ahead and do that. All right, I think everyone understands that Google is able to pursue all these different pursuits because they have enough money on hand because of Google Search, Google Ads, and on YouTube. On the flip side, when times are tough, companies tend to reduce their advertising budgets and minimize marketing to save on margins. That means advertisements, which is the main bread and butter for Google, will take a revenue hit during economic downturns. So even though it's reliable and predictable, like we looked at earlier, their revenue did go down during the pandemic by about 1.6%. It's not like it's dropping by 10% or 15%. It just goes down by a little bit. But it is worth mentioning. It's not all all brightness and rainbows when it comes to Google. But when I think about an economic moat when it comes to Google, I truly believe that they are best in class in several categories, right? We already agreed that it's not Google Cloud. But when we think about search engines, yes, Google wins. Arguably the best web browser, yeah, it's going to be Google Chrome. And YouTube, yeah, what you are watching this video on right now, I think it's the best video sharing platform on all of the internet. Everyone else that competes in those industries are going to be second to Google's dominance. If you disagree with me, name one that is better than Google in one of those three areas. The gap between first and second place is gigantic. I'm sorry, it's just the way it is. Before you get triggered or offended and you're going to say something like Mozilla Firefox or another browser, hear me out, okay? Let me expand on this. The company's search engine has become so dominant that right now, if you look it up on Merriam-Webster, which is a dictionary service, it now recognizes Google as a verb synonymous with searching on the internet. So when we say to Google something, we all know that it means to look it up online. Talk about an economic moat. And over the past 2 decades, Google search has solidified its position as the most sophisticated search engine available, thanks to its AI and its ability to remember what you searched for and to bring up the best search results. Since 2009, over 80% of the search market is dominated by Google. And this statistic actually jumps up to 90% when we think about mobile devices. 90% of searches that are happening on a phone, they use Google to search for. Now, I think that's crazy. And I believe at one point, Yahoo used to be a real contender, and even Ask Jeeves, yeah, they were a part of the conversation. But now, in 2024, it's Google for the old people, and it's also Google for the young people. And here's why their Google search business is the depiction of two birds with one stone. If you've heard of that phrase before, let me explain it right here. With Google search, not only does it fulfill the need of people searching stuff on the web, but it also allows businesses to paste their product or service as an advertisement along with those search results. And most importantly, Google earns user data from these search queries that they also profit from. So it's double the efficiency, and it's crazy how much information Google knows about you. One of the biggest steals in business history was when Google bought out YouTube in 2006 for about $1.6 billion. They had the vision to see how big it was going to be. Another one is when Facebook bought out Instagram. It was a highway robbery, but this is not about Meta. Anyways, since 2006, YouTube has now grown into becoming one of the largest video sharing and streaming platforms around the world. When we think about African countries, yeah, it's going to be YouTube. When we think about India, yeah, it's going to be YouTube. When we think about Japan, yes, it's also YouTube. Canada, Germany, the UK, the US, Mexico, everybody is using YouTube. I don't think you understand just how big YouTube is. The reach is remarkable. With over 2 billion monthly users, over 1 billion hours of content being watched daily, YouTube is insane. And YouTube isn't just for watching videos like this, what you're seeing right now. YouTube also offers subscription options like YouTube Music, YouTube Premium, which by the way has about 100 paying million subscribers. And they also have what you see on your screen right now, YouTube TV, which is like your traditional cable streaming service, but you have access to all of the different channels. And they have about 8 million paying subscribers. So when I think about Netflix, their business model is really unidimensional. But when I think about Google, but just look at their different avenues and lines of business. I don't know why you would ever want to pick Netflix over Google. Google is far superior in my opinion. One could argue, why not just invest into both? And that's probably the best case. But with YouTube TV, you can watch sports, the news, TV shows, or whatever you want. And before we go any further, I wanted to circle back to the Google Cloud. Although Google Cloud only has a small fraction of the cloud space, It is worth mentioning that their number of customers are growing by the quarter. Like right now, these are all the different companies that pay Google to use Google Cloud, whether it's the Google Workspace or their storage facilities. Or actually, before I get ahead of myself, we'll go ahead and look at the Google products and services in the next like 2 minutes or so. But look at this: Uber, Goldman Sachs, Wendy's, sir, this is Wendy's, GitLab, show more. The people want to know. eBay, Wayfair, which, by the way, I don't know if I have what it takes to order a $3,000 sofa or a couch off the internet without sitting on one. I just don't feel comfortable buying furniture online. Let's see, Victoria's Secret, Backcountry, show more, show the people. Continental Tires, Fox Sports, McCormick. We have a university system, show more. As you can see, even though like Amazon and Microsoft dominate the cloud space, Google is nothing to laugh at, right? They got Domino's, one of my most favorite food stocks. Let's see, they got Priceline, SEMrush, and they even have General Mills as a paying customer. So why would a company want to go with Google over Microsoft and Amazon? Well, take a look at this, okay? Google offers a ton of services. There's over 100 options so that there is something for everyone. What is this? 900 plus partners, 135 languages translated in just a few clicks. That would be really useful for whatever data you're working with. And if you go with Google Cloud, it comes with the Google cybersecurity system. So this right here are the most popular products and services that companies like to buy from Google Cloud, including the cloud storage, some AI, and Gemini. We also have Cloud Run. And as we scroll down, you could just see the catalog from Google Cloud is just absolutely massive, ranging from AI and machine learning all the way down to business intelligence. There's also the containers, data analytics, databases, developer tools, whatever you're looking for, Google can provide that. And that's why some people prefer the Google system over Microsoft or over Amazon. And here's where I'm coming from. I like Microsoft. I really do. I think Microsoft just has the best Excel sheets. Their Word document is best in class. But with that said, I use Google Workspace for everything. I use Google Sheets, Google Docs, Google Slides. Most of my videos were actually produced on Google Slides. And I mentioned this because Google Workspace, all of those products that I just mentioned, they're a part of the Google Cloud ecosystem. So when we think about Google's revenue source from Google Cloud, that's tied into it. And as you can see on the screen right now, I'm about halfway done with scrolling, and the services and products offered through Google Cloud, we've only reached the letter M. And as we fast scroll, what do we see? Maps, media services, migration, mixed reality, networking, operations, productivity, security. My gosh. All I'm trying to say is Microsoft ought to watch their back because Google, I think, is catching up. And I know earlier we talked about Google Pixel being their phones, but did you know that Google is also in the semiconductor business? Meaning they make chips for their Pixel line of products. It's called a Tensor, what you see on your screen right now. And their latest chip is called the G4. And I'll say this, even though Google is in the phone business, I think the Pixel lineup pales in comparison to the technology of the Samsung Galaxy series and the popularity of the Apple iPhone. Because even if the Pixel specs are better on paper, the probability of a glitch or having the phone malfunction is statistically higher than an iPhone. iPhone is known for its quality, for its low defect rate. But when it comes to the Google Pixel phones, apparently that's just not the case. When I was in the market for a new phone, back like 6, 7, 8 months ago. Remember, I was asking you guys like, which one should I go with? What phone do you use? And for me, it boiled down between a Pixel Pro and an iPhone. And after looking at almost every YouTube video and looking at all the different reviews, I ultimately went with an iPhone because of how unreliable the Pixel can be. There's people saying like, man, the battery just overheats, the phone shuts down randomly, the screen turns off. I just didn't want to take that risk. So I just went with an iPhone and it has yet to let me down. It's reliable. It works as it should. Now, does the iPhone have the best technology available on the market? No, but it's simple and it works when it should. There's nothing more frustrating when you want to open up an app or when you need to do something and your phone starts glitching. And that's been in my experience when I used to have a Google phone like 10 years ago as well. I wanted to give them a second chance, but it turns out even in 2024, their production and manufacturing of the phone, something's going wrong in the supply chain where the defect rate is it just doesn't make me feel secure. So all that to say, are you convinced yet that Google is one of the best companies on the stock market? I know leading up to this, I just ended it on a very negative note with their phones. But if you're still not convinced, then it's time for me to elaborate on the Google Play Store. When you use an Android, it doesn't matter if it's a Huawei or a Samsung or a Motorola. If you use an Android and you want to download an app, you most likely will use that avenue, the Google Play Store. For every sale and transaction that happens on Google Play, or when you buy something through your mobile app, Google collects a fee from the developer. So say you spend $10 to buy something, like $3 of those dollars are going to go to Google. This fee, after accounting for the cost of running Google Play, is most likely incredibly lucrative from an operating margin perspective. Other people out there are the ones that are putting in the effort, the sweat to make these apps, and Google just collects that fee. So when you buy an update for a game or a paid app, Google gets a cut of that check. This is quite literally the definition of a toll booth company. And believe me when I say, there are people that spend hundreds, if not thousands of dollars a month on mobile games every month. So just think about that revenue stream that Google gets. And lastly, before we move on to the next segment of this video, just think about this, okay? If Waymo, the self-driving vehicle technology that Google is working on, if it actually works out and it passes through all of the legal battles that they have to go through, and Uber buys a contract for that technology from Google or even Lyft, or all of the other ride-sharing apps around the world, if they buy it from Google, that's going to be a gigantic, huge source of revenue to come in the future. Right now, Waymo, what you see on your screen right now, it only operates in a few cities like Phoenix, San Francisco, and Los Angeles. But Waymo, in my personal opinion, I think it's a catalyst that people don't give enough attention to. Because when this rolls out on the streets for almost every major metropolitan area, I think it's going to be a game changer. This has the potential to put taxi drivers out. So as you can see, Google is more than just a search engine or YouTube. You just learned that Google has over hundreds of products and services, but not only that, they have their own R&D laboratory that are like stealth projects. Google has a ton of catalysts going in their favor. And in the meantime, yeah, they have their Google search and ads, which is their bread and butter, which is going to be a reliable source of revenue. And they have billions of dollars of cash on hand to afford to do little projects like Waymo. Now, very recently, Google posted their Q2 earnings, and they beat on the revenue and on the EPS, which was to be expected, right? Let's go ahead and take a look at it. Year over year, in 2023, the revenue was $74 billion, as we saw earlier, and now it's $84 billion as of 2024. That increased by roughly, 14%? Phenomenal. And as we scroll down, we get to see a breakdown of their revenue searches. Pay attention to the right column. In 2024, Google search accounted for $48 billion of the $84 billion. So as you can see, that is their bread and butter. The YouTube ads, the Google network, they pull all of that together to collectively spit out $64 billion. This is fantastic. Their other bets, right? The R&D lab and all of those other like small projects we talked about, it only accounts for $365 million. I say, quote unquote, only. But even then, I think that's still impressive. And then their total income from operations is sitting at $27 billion, which is phenomenal. The only call out that I have that's a little concerning is the amount of employees that they have, right? It's just shy of 180 1,000 employees. For a tech company, I think that headcount is a little too big. I feel like Google could actually trim their workforce by like 2 to 3% and still run efficiently. There's probably a lot of people on their staff that aren't contributing much but are taking up space on the payroll. But then again, who cares? In the grand scheme of things, this is a company that still makes billions of dollars. So who am I to say those people shouldn't have jobs? If there are workers at Google that are making like $220,000 a year, barely doing anything except showing up to a meeting once a week, then more power to them. Good for them. I'm not going to be that jerk to be like, hey, they shouldn't be a part of the team. But just saying, just throwing it out there, devil's advocate, that if Google were to, trim 2 to 3% of the workforce, it would be a little more efficient, but who cares? This is a company that is rolling in cash. It doesn't really matter. All right, friends and family, now we made it to my most favorite part of the video. We're going to run some valuation models to figure out what the intrinsic value for Google should be. Now, as a refresher, at the time of filming this video, they're currently trading for about $159 a share, okay? Keep that in mind. The first one is going to be the multiples valuation. Essentially, their industry peers are going to tell us what Google should be valued at. I just went ahead and plugged and chugged the other Magnificent Seven companies. And based on that, the multiples valuation is going to be $257 a share, contingent upon a PE ratio of 36.8. I believe right now, Google's is close to like 21 or 22. The next one is going to be the discounted cash flow analysis model. Essentially, the free cash flow is going to tell us how much Google is worth. And as we saw earlier, their free cash flow is just a beautiful picture. The average growth rate year over year is 27%. But as you know on this channel, we like to play it safe and use conservative numbers because we don't want to be too optimistic, just in case they have a roadblock they end up hurdling in the not too far distant future. So I went ahead and shaved off 7% and say, hey, Google is going to be able to grow their free cash flow by 20% year over year, which sounds a lot more sustainable than 27%. So taking that into consideration with some balance sheet numbers, by the way, check this out. Right now, they have over $100 billion of cash and cash equivalents on hand. To counter that, they have $28 billion of total debt, which means you don't even need to know accounting 101 to understand that they could pay off their total debt about 4 times over. They have that much cash on hand. They remind me of Apple. But anyways, taking all of these numbers into consideration, the DCF price for Google is going to be $238 a share. So the first one said $257, DCF said $238. Google is trading for $159. Moving on, the DDM. They just started paying a dividend, so we don't have that much data available. So I just went ahead and assumed that Google is going to grow that dividend by 7.5% year over year, because I think currently the payout ratio is something like 10 or 13%, one of those two numbers, which means it's really sustainable and they have a lot more room for growth in their dividend. And I think they are going to grow it at a very modest rate. So 7.5%. Based on that, the DDM for Google is going to be $172 a share. And last but not least is going to be the Graham's valuation. Based on their growth rate projection and the current AAA corporate bonds yield rate, we're going to figure out how much Google is worth. And it's going to be $196 a share. So I think the lowest one out of the 4 was the dividend discount model. And that's because Google really doesn't have that much dividend history because they just started to initiate paying one as of this year. And it's 20 cents a quarter, which is nothing to write home about. But you don't invest into Google for the dividend, right? You invest into it for the growth. And I think they strategically started to pay a dividend because they wanted to be included into more index funds and ETFs. Because a lot of the more popular ETFs, believe it or not, require the company to pay a dividend. And because Google does not pay a dividend, they were not included. But now they're part of the conversation. I think it was a really smart thing for them to do. Which brings us to the conclusion. So now that we looked at all the different valuation models, what is the intrinsic value for Google? Jimmy, you already know what's going to happen. Hit him with the drum roll. Ba 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 ba. The intrinsic value for Google is going to be $215 a share. Not bad, right? They're currently trading for $159. The Wall Street analysts believe that the price target for Google should be 209. So we're not too far off from one another, and we're thinking along the same wavelength. We think that Google is undervalued. So now that I've went through all the numbers, looked at the data, looked at the intangibles and their future catalysts, I want to figure out an acceptable buy price for Google. I don't want to be ripped off, and I don't want to overpay for the company, okay? So based on that, let's go ahead and do some quick calculations. We're not going to say 30. We're going to go ahead and say 10%. With a 10% margin of safety baked in, then my acceptable buy price to their intrinsic valuation is going to be $194 a share. But let's go ahead and say, because with Google's uncertain future of a potential breakup because they are a monopoly and they're not fair, let's say that we need a bigger margin of safety to feel comfortable about this investment. A 20% margin of safety baked in is going to be $172 a share. If I were to buy into Google right now, then I would approximately get a 26% margin of safety, meaning the probability of my investment going up by 26% within the next 12 months is pretty high, but it's not foolproof. So buying it right now would get me a 26% margin of safety. And remember how at the beginning of the video I said that Google is undervalued? Well, do I still believe that to be the case? Absolutely. Because right now, when we look at Google, they are currently year to date, they're up by 15%, which is not bad. Their PE ratio is sitting at 22.8, which seems to be in line with the rest of the S&P 500, except this is not an average company like General Mills or Procter & Gamble or UPS. We're talking about Google. And I say that because when we look at Google's peers, like Amazon, for instance, investors say that Amazon have an economic moat in their lines of business. And as such, the market is bullish on their future prospects. As a result, their trading multiple reflects that, right? And Amazon's PE ratio of 44 is much higher than Google's. But my thing is, I'm bullish on Google because advertising is here today and it's going to be here tomorrow. The Google search, it's not going anywhere. Not only that, Google's other prospects are up and coming. Or one of their other projects in the shadows could hit it big. Remember, we reviewed all of the different projects that Google is doing right now. So for me, it's like, if I invest into Google, I get the safe and steady Google by investing in that. And then in the future, if one of their bets work out, then I win even more. So when we look at Amazon, they're currently up by 24% year to date. When we look at another peer, which is Microsoft, they're up by 17% year to date, but their trading multiple is sitting at 36.8. And when we look at Apple, their trading multiple is 33. So tell me, why is Google sitting at 22 as if it's some random business in the S&P 500? This is not a random business. This is one of the biggest tech giants in the world. Anyways, I feel like I'm preaching to the choir. I think everyone now understands that Google is not a speculative company. Google has a solid business operation. They have billions of dollars of cash on hand, and it's a leader in the technology industry. And I'm not saying all of this to be biased because I am actually invested into Google, but rather I'm saying all of this because I truly believe that Google is undervalued right now. 12 months from now, look back at this video because I think Google has the potential to reach $200 a share, maybe even $215 a share. To trade at 159, I think Google is criminally undervalued to me, according to my own calculation and beliefs. Now, although Google is pushing for innovation in the tech space, what you see on your screen right now, all of their different R&D projects, I have friends that are in the company. And from what I have heard from them, the red tape is starting to become a problem. So a lot of them, once their RSUs are vested, they usually leave Google to join another startup company in 3 or 5 years. Because if you have worked in corporate America before, you know just how annoying red tape can be when you need like 20 different signatures to get anything done. It really slows down a project, meaning Google is not as agile as they used to be when they were a younger company. But that's because, remember earlier I said, they have 180,000 employees. So that's to be expected. When there's that many people in a company, you do want to be safe and make sure all your I's are dotted and your T's are crossed. Regardless, I like Google. So I'm personally going to be buying into it whenever it goes on a dip. I think it's a dividend compounder with cheese, and I think it's delicious. But that's my personal game plan. Please do your own due diligence and research to figure out if you like Google or not. Because I say it all the time, I'm an idiot. I'm genuinely an idiot, and I could be wrong. But I think Google is amazing. Now, with that said, I love you guys. Take it easy, stay safe, and I'll talk to you next time.